The financial world is entering a moment that very few people are prepared for. For years, most investors believed that gold and silver would simply move slowly, quietly, gradually appreciating over time. They were treated as conservative stores of value, insurance, something you hold quietly in the background while the rest of the financial world grabs attention. But something has changed. The signals appearing across global markets are not normal signals. They are not the kind of signals that appear during ordinary market cycles. These are pressure signals, stress signals, signals that historically appear when monetary systems begin shifting beneath the surface. And when those signals appear, precious metals do not behave the way people expect. They explode. But before we talk about where gold and silver may be headed, we need to understand something far more important. Markets move based on psychology, not headlines, not opinions, not predictions. Psychology. Every price chart in existence is nothing more than a map of human behavior. It records fear. It records greed. It records hesitation. It records regret. And right now, the psychology surrounding gold and silver is reaching a critical turning point. For months, both metals have been trading within tight ranges. Prices have moved up, pulled back, surged again, and then stalled near key levels. To many observers, this has looked confusing, even frustrating. But to those who understand how markets work, this kind of behavior is extremely familiar. Before the largest moves in history, markets often compress. They tighten, they squeeze. Price becomes trapped between resistance above and support below, creating what traders call pressure zones. In these zones, buyers and sellers fight for control. Every move higher meets selling pressure. Every drop finds buyers stepping in. This back-and-forth battle can last weeks, sometimes months, but it cannot last forever. Eventually, one side wins. And when that happens, the move that follows is rarely small. Right now, gold is sitting directly beneath one of the most important resistance levels it has tested in years. This level has acted as a ceiling before. When price reached it previously, the market rejected the move almost immediately. The rejection was violent. Prices dropped sharply after reaching that level, leaving behind a very clear signal on the chart. A candle formed that technicians often view as a warning sign. It had a long wick on top, a long tail at the bottom, and the closing price sat almost directly in the middle. This type of structure represents indecision. Buyers pushed the price higher, sellers pushed it lower, and neither side managed to fully dominate. But what happened next told the real story. After that candle appeared, gold fell. The sellers won the battle. Now, months later, the market has returned to that same level again. And this is where things become interesting, because markets have memory. Traders remember where they bought. They remember where they lost money. They remember where they felt trapped. Imagine someone who bought gold near the top of the previous surge. They were convinced the breakout would continue. Momentum looked strong. The move felt unstoppable. Then suddenly the price collapsed. Instead of profit, they were left holding a losing position. Days passed, weeks passed. The price remained below their entry. Emotionally, that creates pressure. And when the market finally climbs back to their original purchase level, many traders react in the same way. They sell, not because they believe gold is weak, but because they want to escape the trade without losing money. This phenomenon happens everywhere in financial markets. Break-even psychology. When price revisits a previous peak where many traders bought before a decline, it often encounters heavy selling pressure. That selling pressure can stall the rally, sometimes for extended periods. And that is exactly the situation gold is facing right now. The market has returned to that critical resistance zone. Some traders are selling, others are buying. Long-term investors are holding. Momentum traders are watching closely. Everyone is waiting for the same thing. A decision. If buyers manage to push gold decisively above this resistance level, the structure of the entire chart changes. Once resistance breaks, it often transforms into support. The traders who sold earlier begin to regret their decision. New buyers enter the market, momentum accelerates, and suddenly, a market that looked slow and uncertain begins moving with explosive speed. Above this level sits the next major target zone, a level that historically has acted as a peak in previous rallies. If price reaches that zone and breaks through it, something even more powerful happens. Price discovery. Price discovery occurs when an asset trades beyond all previous historical highs. There are no previous resistance levels above it, no reference points, no historical sellers waiting to exit. The market begins exploring entirely new territory. When that happens, moves can become extremely aggressive. But there is another side to the story as well. Markets do not move in straight lines. Even the strongest trends experience pullbacks. And beneath the current gold price sits an important support structure. This support zone has been forming gradually through higher lows. Each time price dipped in recent months, buyers stepped in earlier than before. That behavior created an upward sloping trend line. Trend lines represent confidence. When buyers consistently enter the market at higher prices during pullbacks, it shows growing conviction that the asset will move higher over time. But if that trend line breaks, the message changes. A break below, rising support, often signals that momentum is weakening. If that were to happen, gold could temporarily retreat toward lower support zones where stronger buyers may step in again. And that is why the current moment is so critical. Gold is trapped between two forces: resistance above, support below. This compression cannot continue forever. Sooner or later, one side will overpower the other. And when the breakout comes, it could reshape the trajectory of precious metals for years. Now let's talk about silver. Because while gold receives most of the attention, silver has historically produced some of the most explosive moves in financial history. Silver behaves differently from gold. It is more volatile, more emotional, more reactive. When precious metals enter strong bull markets, silver often accelerates faster than gold. But when corrections occur, silver can fall harder as well. This volatility is part of what makes silver so fascinating. Right now, silver is sitting inside a pattern that analysts refer to as an inside bar consolidation. In simple terms, this means the price is trading within the range of a previous large move. After experiencing a strong downward move, silver began stabilizing inside that range. It started forming smaller price swings, higher lows, lower highs. The result is a tightening consolidation zone. Some analysts interpret this type of structure as a bearish flag. A bearish flag forms when price drops sharply and then consolidates before potentially continuing lower. But markets are rarely that simple. Patterns are not guarantees. They are probabilities. And probabilities shift as price behavior evolves. Recently, silver attempted something important. It moved above a key resistance zone that had previously stopped rallies. This resistance zone formed during earlier consolidation periods before the large drop. When price finally pushed above that level, it created the possibility that the bearish pattern might be weakening. But one move alone is not enough to confirm a breakout. True breakouts require follow-through. The market must demonstrate that buyers are willing to keep pushing higher. That means closing above recent highs. If that happens, the next major target zone for silver appears significantly higher. But even reaching that target would not necessarily eliminate the larger consolidation structure. To completely invalidate the bearish flag pattern, silver would need to rise above a much higher threshold, a level that represents the upper boundary of the entire consolidation range. Only above that level would the chart begin signaling the possibility of a full long-term breakout. And if that happens, the implications become enormous. Because historically, when silver escapes major consolidation patterns after long periods of compression, the resulting moves can be extraordinary. But again, nothing in markets is guaranteed. Breakouts can fail. False signals occur. If silver fails to maintain strength above its recent resistance, the price could fall back into the consolidation zone. Below that zone sits another support level, where buyers previously stepped in. And below that sits an even deeper support area that has historically attracted strong demand. These are the levels traders are watching closely, because markets move in stages: breakouts, retests, confirmations, reversals. Every stage tells a story about the balance between buyers and sellers. And right now, both gold and silver are sitting at levels where the next chapter of that story is about to unfold. The financial world may appear calm on the surface, but beneath that calm surface, enormous forces are building pressure. Monetary policy shifts, global conflicts, currency instability, debt expansion, inflation uncertainty. All of these forces interact with investor psychology. And when psychology begins shifting toward fear of currency debasement, precious metals often become the focal point of global capital flows. That is why these levels matter. They are not just numbers on charts. They represent the tipping points where perception changes, where hesitation turns into urgency, where patience turns into panic buying. For years, gold and silver have been quietly building the foundations for a potentially historic move. Now those foundations are being tested, and the outcome of this battle between resistance and support may determine the direction of precious metals for the next decade. The reason this moment matters so much is because markets rarely give warnings before massive moves. Most people believe they will see it coming. They believe there will be clear signals, obvious headlines, and enough time to react. History shows the opposite. Major financial shifts almost always happen while the majority of people are distracted by normal daily life. By the time the public realizes what is happening, the move has already begun. And when it comes to precious metals, the early stage of a breakout often looks confusing. Prices move sideways, then they move slightly higher, then they pull back again. Analysts argue, traders debate. But beneath that slow movement, something extremely important is happening. Accumulation. Large capital does not enter markets all at once. When institutions, sovereign funds, or long-term investors want to build positions in assets like gold and silver, they cannot simply buy everything in a single day. Doing that would push the price violently higher and reveal their intentions. Instead, they accumulate slowly. They buy during dips. They buy during periods of boredom when public attention is elsewhere. They allow the market to move sideways while quietly absorbing supply. Over time, this process builds a foundation beneath the price. At first, it is invisible, but eventually the available supply begins shrinking. Sellers disappear. And suddenly, a market that seemed quiet begins to move with unexpected strength. This is why consolidation periods are so important. Many investors view sideways markets as pointless. They become impatient. They move their money into assets that appear more exciting, but consolidation is often the stage where the next major move is quietly being prepared. When a market compresses between resistance and support for long enough, pressure builds like a spring. The longer that compression lasts, the more powerful the eventual release can be. Right now, both gold and silver are displaying exactly this type of compression. Every rally meets resistance, Every decline finds buyers. Price keeps tightening into a narrower range, and eventually, one side will lose control. If the buyers win, the breakout could trigger a chain reaction across the entire precious metals market. The reason is simple. Many investors who currently have no exposure to gold or silver are watching from the sidelines. They are waiting for confirmation. They want to see proof that the breakout is real before committing capital. Once resistance levels are clearly broken, that confirmation arrives, and when confirmation arrives, new buyers enter the market. Momentum funds join, trend-following algorithms activate, technical traders pile in. Even traditional investors who previously ignored precious metals begin reconsidering their positions. This is how bull markets accelerate. But the psychology does not stop there. Another powerful force begins influencing the market during breakouts: regret. Investors who hesitated while prices were lower suddenly feel pressure as the market rises without them. They begin calculating what they missed. They start imagining where the price might go next. This emotional pressure leads to what traders call fear of missing out. And fear of missing out can drive prices far beyond what most analysts consider reasonable. Because when regret enters the market, rational decision-making begins fading. People stop asking whether the price is cheap. They begin asking whether it will keep rising. That shift in mindset is one of the most powerful forces in finance, and it has driven every major commodity bull market in history. Silver in particular has experienced these emotional explosions before. When silver begins moving aggressively, it rarely does so in a calm, controlled manner. It accelerates, volatility expands, daily price swings become larger, headlines begin appearing everywhere, and suddenly, an asset that spent years being ignored becomes the center of global attention. But there is another dimension to this story that many investors overlook. Precious metals do not exist in isolation. They are deeply connected to the global monetary system. For decades, the modern financial system has been built on expanding debt, expanding money supply, and confidence in paper currencies. As long as that confidence remains strong, precious metals often remain in the background. But when confidence begins weakening, investors search for alternatives. Gold and silver have served as monetary assets for thousands of years. Long before modern currencies existed, these metals were used to store value, facilitate trade, and protect wealth from political and economic instability. That historical role still influences investor behavior today. When uncertainty rises, capital often flows toward tangible stores of value. And this is where the broader environment becomes important. Around the world, governments continue expanding debt levels. Currencies face persistent inflation pressures. Geopolitical tensions periodically disrupt markets. Financial systems grow increasingly complex and interconnected. Each of these factors adds another layer of uncertainty. And uncertainty is the fuel that often drives demand for precious metals. This does not mean prices rise in a straight line. Markets still move through cycles. There are rallies, corrections, periods of euphoria, and periods of doubt. But the long-term trajectory of precious metals has historically been closely linked to confidence in financial systems. When confidence is strong, metals often move slowly. When confidence weakens, metals can move dramatically. Right now, the global environment is sending mixed signals. On one hand, financial markets continue functioning. Stock markets remain active. Currencies still circulate normally. But beneath that surface stability, structural pressures are building. Debt continues expanding faster than economic growth. Central banks face difficult choices between controlling inflation and maintaining financial stability. And geopolitical tensions periodically disrupt the delicate balance that global markets rely on. These pressures do not immediately break systems. Instead, they gradually reshape investor expectations. People begin questioning whether current policies are sustainable. They begin asking whether purchasing power will remain stable. They begin considering whether traditional financial assets alone are enough to protect wealth. And when these questions begin spreading through the investment world, precious metals often move from the margins toward the center of attention. This shift rarely happens overnight. It unfolds gradually, first through quiet accumulation, then through technical breakouts, then through accelerating momentum, and eventually through widespread public awareness. At the moment, gold appears to be showing stronger momentum than silver. Its structure is pressing against resistance levels that could trigger new highs if broken. Silver, meanwhile, is still navigating a more complex technical pattern. It has shown signs of strength by pushing above recent resistance, but confirmation remains essential. If silver manages to sustain that breakout and continue climbing, the next resistance levels appear significantly higher. Beyond those levels lies the threshold that would completely invalidate the bearish consolidation structure. Crossing that threshold would dramatically change the long-term outlook, because once that barrier is broken, the market structure transitions from consolidation into expansion. Expansion phases are where the most dramatic price movements occur. During expansion, the range of price movement widens, volatility increases, momentum attracts more capital, and the market begins climbing through levels that once seemed distant. In this type of environment, the gold-to-silver relationship also becomes extremely important. Historically, during the early stages of precious metal bull markets, gold often leads. It attracts capital first because it is widely recognized as a monetary asset, but as the cycle progresses, silver frequently begins outperforming. The reason is partly psychological and partly structural. Silver is a smaller market. Smaller markets react more dramatically to capital inflows. When large amounts of investment demand suddenly target a smaller asset class, the resulting price movement can be explosive. This dynamic has played out repeatedly throughout financial history, and it is one of the reasons why many investors watch silver so closely whenever gold begins approaching new highs. But again, patience is required. Markets must confirm their intentions. Breakouts must hold. Resistance must turn into support. Momentum must sustain itself beyond the first surge. This process often frustrates impatient traders. They expect instant results, but major structural shifts unfold in stages. The early stage is uncertainty. The middle stage is acceleration. The final stage is widespread participation. Right now, precious metals appear to be transitioning between uncertainty and acceleration. The charts are tightening. Key levels are being tested. Momentum is beginning to build, but confirmation is still unfolding. If the breakouts continue developing, the targets that once seemed distant may begin appearing much closer. A move toward levels that many analysts previously considered extreme could become increasingly realistic. Silver pushing toward triple-digit territory, gold advancing into entirely new historical ranges. These possibilities may sound dramatic, but financial history is filled with moments where markets moved far beyond expectations once structural breakouts occurred. The key is recognizing the signals early, understanding the psychology, watching how price reacts to critical levels. Because when resistance finally breaks, markets rarely pause to ask whether investors are ready. They simply move, and those moves can redefine entire asset classes. For those watching closely, the current moment is not just another ordinary fluctuation in precious metals. It is a potential inflection point, a moment where years of consolidation may be preparing to transform into expansion, a moment where quiet accumulation may give way to powerful momentum, a moment where gold and silver could begin writing the next chapter in their long monetary history. But as always in markets, the outcome will depend on one simple question. Will buyers prove strong enough to push prices beyond the barriers that have contained them for so long? Or will resistance once again hold, forcing metals back into consolidation? The answer to that question may arrive sooner than most people expect, because the pressure building inside these charts cannot remain contained forever. And when it finally releases, the move that follows could change how investors around the world view gold and silver for years to come. In markets, there are moments that pass quietly and moments that define entire cycles. This may be one of those defining moments, a moment where the next phase for precious metals begins. And for anyone holding gold or silver, understanding that possibility may be more important than ever. The signals are forming, the levels are being tested, the pressure is building, and the next move could be the one that everyone remembers. So the situation right now is simple but extremely important. Gold is pressing against a level that has stopped it before, while silver is attempting to escape a consolidation pattern that has contained it for months. These are not random movements. These are pressure points where markets decide their next direction. If buyers take control and push prices beyond these barriers, the next phase for precious metals could unfold very quickly, with targets that many investors once believed were far away, suddenly coming into view. But if resistance holds, the market may need more time before the real breakout begins. Either way, one thing is clear: gold and silver are no longer in a quiet phase. They are approaching a moment where the next move could reshape the entire landscape of precious metals. And when that move finally happens, the difference between those who were paying attention and those who were not may become impossible to ignore.